everyone. Welcome to Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall. It is 3 p.m. here. Let's get you caught up to speed on the market action here. It all comes down to this. 1 hour left in trade. Take a look at the Dow, the S&P 500, and the Nasdaq. All of them either at or near session highs right now. The Dow is higher by about 1.5%. S&P 500, you're seeing that higher by 1.5% on the button. And then the Nasdaq Composite, that too, we'll just say 1.5%. Why not? Trifecta, hat trick. All the way across the board, you got the triple double there. Here with more on the latest market action today, we've got our very own Jared Blick-Reed. Jared, what are we saying?
All right, as you just said, we are seeing some nice up action. Really interesting. Dow, S&P 500, Nasdaq all tied for about 1.4, 1.5% in gains. Russell 2000 taking a backseat today, although it has been surging recently. And we've got a number of milestones or potential headwinds in the rearview mirror right now. Of course, we had that big Fed meeting yesterday, the day before CPI. All of this started, I'm noticing this rally where we had this value and cyclicals finally back in play again. It started about 2 weeks ago, though, with that big jobs report at the beginning of the month for those May numbers where payrolls exceeded expectations, and now it's been off to the races. Let me just show you what's happened this week alone. Tech, guess what? Tech is not out anymore. It's in the forefront. Consumer discretionary, that's retail, also includes Amazon. Communication services, the mega cap sectors leading again, but they're joined by materials and industrials, with staples taking a little bit of a back seat here. And if you look over the last 10 days, really pronounced to see the value and cyclical trade and the breadth of this rally expand. Something I'm writing about in the morning brief tomorrow. We've seen the cruise lines explode to the upside, and we can take a look at that real briefly, along with some other considerations here. And here's the travel reopening. This is over the last 4 days, but we can see Southwest Airlines, that had been in the red up until about 2 weeks ago. That's up 17% in 10 days. Delta Airlines, I think this is what, 15 days in a row that it's going to be green, something like that. It's up 18% over the last 10 days. Carnival Cruise Line's up 35%. That is one of the top performing names that we have over the last 2 weeks. So all put together, rally looking decent. However, I would put this in perspective. We're getting really overbought on some of the indices, especially the Nasdaq 100. That has just been going gangbusters. I'm going to show you here, let me just pull this up, over the last 2 years. We have now approached levels in the Nasdaq 100 we haven't seen for quite a long time. So it's going to be a big test to see if we can move beyond that. But in terms of risk, it's risk on today. I was down at the New York Stock Exchange earlier this morning, and I saw the Kava IPO. I saw them trying to open there, but there were more people on the floor than I have seen in years. And let's take a look at what's happening. That's Carvana. Let's see what's happening with Kava Group right there. Number one in our trending tickers list. You can see up and away the IPO price way down there by about, what, $21, $22, now trading at $43.50. That is a 100% gain. Very important signal for the capital markets that IPO is back in favor again. It has been a long time since we have seen a unicorn. And we also had Brooke DePalma, our own Brooke DePalma, down there interviewing the Kava CEO. And here's what he had to say.
We're focused on our long-term growth. We've got a tremendous unit economic profit engine. We saw in Q1 alone, we generated $50 million at the restaurant level. That's compared to $91 million all of last year. So very healthy margins at the restaurant level, and that's kind of the lifeblood, the oxygen of our business. And we've invested in significant infrastructure over the years, whether that's our manufacturing infrastructure, our digital infrastructure, or all the new restaurants. All the new restaurants we've opened over the last few years, and all of that is now flowing into the business and really creating great tailwinds on that path.
Some interesting comments about the margins there and path to profitability. Almost difficult to hear. That's how many people were on the floor there. So nice to see. This is another form of the reopening, guys.
Yeah, Jared, certainly the market's very much ready for the reemergence of some of these IPOs to come back into the fray. Good stuff. Our own Jared Blick breaking it down, and not to mention sprinting back from the New York Stock Exchange.
Indeed. All right, let's dig deeper into shares of the fast casual restaurant Kava. That stock soaring, as Jared mentioned, extension up nearly 100% after its IPO this morning. The Mediterranean chain went public at $22 a share after raising its pricing expectations at the start of the week. For more market reaction on the news, we turn to Tom Hayes, Great Hill Capital Chairman and Managing Member. So, Tom, let's dig into this.
Yeah.
I'm sorry, you're going to get a bunch of puns with this one.
I'm with you.
So the appetite is there. Another one, sorry. 2 for 1. But is this just kind of the brand new shiny thing?
Shiny objects we are in need of. It's been a long 18 months. The market's been dead for new IPOs. And I don't know if the buoyant market is better for Kava or Kava is better for the buoyant market. But I can tell you one thing. Those bankers are not going to be laying on a beach in the Hamptons this summer. They're going to be back out on the street doing deals. There's probably a couple dozen waiting to go. There's huge amount of demand, and the old saying go, when the ducks are quacking, feed them, and the ducks are quacking. You're seeing this thing up. There was indication of interest, maybe $19, $20 or earlier this week. It's came out at 22. It's up almost 100%. They're not making any money, but it shows the pent-up demand from 18 months. And now with the Fed probably out of the way, I think risk is back on, and you're seeing it reflected today.
We've broken through one of the tops that we had seen for the markets, for the S&P 500 at least, and we've continued to move higher since the course of the end of May. Does this move that we're watching in Kava today signal that the environment is more favorable for IPOs to finally get into the fray and that it's game on now for more of the deals?
It's absolutely game on. And this is not only going to be good for the markets, this is going to be good for investors. This is going to be good for bank earnings. You know, if you look at the big banks, they've kind of been lethargic, particularly since the mini crisis in March and April, if you remember. Now you've got this whole avenue of income that they haven't had for 18 months. These bankers have been playing a lot of golf. That game is over. They're going to get back to it, and you're going to see deal after deal, you know, whether it's Fuego de Chao, whether it's Shutterstock, many waiting, and I think they're going to get them out as quickly as possible.
Which Fogo would be a re-IPO, if you will.
Exactly.
Almost a, oh my goodness, when they recreate the movies out there again. Anyway.
A sequel, basically.
Yeah. Sequel IPO.
Yeah. But just getting back to Kava, like we talked a little bit about this offline. I mean, and we saw this, the path to profitability. I mean, last year their loss widened. So is this, you know, for Kava itself, so sure the IPO environment now is hot or setting up to be hot. For Kava itself, is this just kind of a flash in the pan?
Well, for the business, it remains to be seen. You have people on two sides of the spectrum. One is this is the next Chipotle, which I'm a little bit skeptical about. The other is it's the next Potbelly, which could be not a good situation. I think it's somewhere in the middle, the truth. I think they're kind of in the sweet spot of healthy, fast, casual, reasonable prices, decent quality food, fresh every single day. So I think overall it was the right thing at the right time. But the name of the game is they control the supply of the stock, right? So you've got this 18 months of demand for stock. The bankers put out a small amount of supply. Everyone wants that supply. They want to get the pops. There's a performance chase now because managers are still in excessive cash. They're underweight the market. So when something like this comes out, everyone wants to get a piece so they can make these quick gains.
I mean, we're talking about a lunch play right now, and I know we got to move on, but we're talking about a lunch play versus a company that you could see go public in ARM as well later on this year, perhaps. So if you kind of compare and contrast someone who's trying to get your lunch dollar or maybe your dinner buck versus a company that quite frankly, has much larger contracts that it could go after in terms of the multi-billion-dollar type of level here.
Yeah, this is a test of the water. I think the bankers wanted to see what is the climate like? Is the market as hot as we think? And what we found out is the market is hotter than we think. An excess amount of demand, a limited amount of supply. It's a perfect combination. You got to stock up 100%. So expect these things to be oversubscribed. Leading into the big one of the year is going to be ARM. That's probably the most important IPO this year.
So let's widen this out a little bit and let's talk about the Fed and the context, the market rallying and the context of the Fed's moves yesterday. I mean, they largely telegraphed what was going to happen. Like we were expecting this skip, if you will, because especially when we see what the dot plot showed, there's no expectations of any rate cuts this year. Is the market getting ahead of itself right now?
No.
Why?
I think the Fed is actually done. And Nick Timiraos, the Fed whisperer from the Wall Street Journal, actually called Jerome Powell on his bluff yesterday. He said, listen, I see this dot plot's at 5.6%. If you're so hawkish, why didn't you raise today? And Jay Powell said, because projections can change. And what everyone knows about the inflation numbers coming in, the base effects this summer, year on year, the owner's equivalent rent is going to drop off a cliff in the month of July, and the next Fed meeting isn't until July 25th, 26th. So I think they're buying time to confirm that inflation is going to come down to the low threes, headline inflation. And if that's the case, they're going to skip again, and that's going to turn into a pause. They will keep rates elevated. There's no question about it, because they want to keep the economy from getting too hot. But keep in mind, we've got 120% debt to GDP. The last thing you want is deflation. We have to run growth a little hot to inflate our way out of 120% debt to GDP like we did after World War II.
Okay. So does that put you in the cut camp? Because you said remain elevated, but you didn't say
I am surprised. You surprised me with that.
You didn't say until when, Tom?
Yeah. I think a good analog for thinking about this would be 1995. So they did do one or two cuts. I'm not in the cut camp. I think they're going to hold it at this level as long as they can.
Yeah.
But the Fed funds rate stayed between 5 and 6% from 1995 all the way till 2000. So they were able to keep rates elevated, and the economy was able to grow above trend. And I think that's the formula they're looking for this time. Little bit above trend inflation, definitely above trend nominal growth. We need that growth to bring down debt to GDP. And I think all the pieces are coming together.
I am surprised by your call. I mean, I'm still in a state of shock. Also, going back to the 90s, I'm like, you don't look old enough to reflect on the 90s. I'm technically old, but I wasn't paying attention enough to that. So again, I'm surprised by this call. And then, so you're saying that the market is not getting ahead of itself, that it's just it's game on in terms of market action now.
I think it's game on in terms of market action. We're seeing pockets of some stocks that are overbought, some indicators that are overbought. You could see a little bit of chop, but I think as far as the IPO game, I think you're going to see a lot of supply in the next few months, and you're going to see it quickly.
All right.
So an IPO summer.
Yes. With the time that we do have left, we got to switch gears here. Let's talk a little earnings, why don't we? It's hard to believe, but we're about a month away from the second quarter earnings season. Yeah, I looked at the calendar of one of the companies that I need to reach out to very briefly here and saw just how quickly that's coming. But anyway, we'll start to get some results sometime mid-July. Usually you can think about some of the airline stocks kind of kicking that off, giving us a precursor to the consumer and the services demand. Then we get banks, and the list goes on. But if you were to wrap up or summarize what we saw in this Q1 earnings season and the guidance that we received as well, what does that set up?
I think the setup is exactly like Q1. Expectations were extremely low, extremely pessimistic, negative 6.7% going into Q1. We finished out slightly below flat, negative 2%, well above expectations. Guidance was better than expectations. And here we go into Q2 with everything that's happened. Expectations are negative 6.4%. And at the same time, you have Atlanta GDP now hovering right around 2%. Yeah. So that old dog don't hunt, that doesn't line up, that doesn't sync. So I think we're set up for another positive surprise. And if you look at earnings expectations for 2024, everyone kept saying when we were down, oh, they got to come down another 20%. They've been coming up the last 4 to 8 weeks, 247 for 2024.
So let me ask you then about sectors. What sectors do you think are going to be the standouts this time around?
I think it's going to be the catch-up trade. So everything that hasn't worked, I think tech's going to continue to do fine. It's going to do less well than it's done on a relative basis. And to Jared's point, we're going to start to see those groups that haven't participated start to participate moving forward.
Okay, so is this a continuation of melt up, or is this just an additional relief rally that we'll see this earnings season?
Under the surface is where all the magic is going to happen. So,
if I forget melt up, how many turn of phrases do you have for us today? This dog don't lie. Go ahead.
So while, even if you take a look, let's say the general indices only go up another 5% into year end, 5, 6, 7%. Maybe they'll go up more and surprise us. There are going to be stocks under the surface that are going to be up 30, 40, 50% that haven't participated. Because if you remember, up till 4 weeks ago, the rally was driven by Magnificent Seven. Basically, 7 stocks drove most of the rally. It's starting to broaden out now. So you could see a subdued S&P index. So I wouldn't be chasing the indices. Look for those things that were part of the 93% that had 0% returns year to date and opportunities moving forward. You're seeing the dollar weaken. Look at multinationals. They're going to benefit from a weak dollar from those foreign earnings.
Okay, we're putting a bookmark. Tom Hayes, stick around. Stay with us. We're going to come back to you after the break and ask for some of your stock picks. Okay. We're just getting started here on Yahoo Finance Live. Coming up, U.S. retail sales for the month of May show signs of resiliency in consumer spending as sales came in better than expected. We'll break down those numbers. That's later in the hour. Plus, tech remains king as Microsoft is heading toward an all-time high. We check in on the software giant in just a bit. And Bitcoin prices falling around 25,000. It fell earlier under 25,000 briefly as the crypto crackdown continues. We've got that and much more coming up when Yahoo Finance returns.
Bonjour! The French Riviera may be famed for playing host to an annual star-studded film festival, beautiful aquatic scenery, and fine cuisine. But for 1 week, hundreds of billions of advertising dollars are at stake. It's the biggest gathering in marketing, media, and tech space. Cannes Lions and Yahoo Finance will be there, talking with C-suite execs from the household brands we all know and love. We'll also speak with some of the biggest profiles in entertainment, such as Cannes Lions 2023 Entertainment Person of the Year, Kevin Hart. Plus, international music artist and producer, will.i.am. 3 big themes coming your way. 1, generating demand during a discretionary spending downturn. 2, leading a values-driven brand through a polarized society. And 3, the role of artificial intelligence in advertising. Join us at the Cannes Lions Festival all week on Yahoo Finance.
There's a lot of uncertainty in the markets. Fed Chair Jerome Powell adding to that feeling after announcing a pause in interest rate hikes. Well, some of the uncertainty seems to be in the rearview mirror. Powell, though, saying despite the pause in June, there may be more hikes ahead, here to help manage some of the questions and give us some stock picks in this context is Tom Hayes, Great Hill Capital Chairman and Managing Member. So let's start with your picks. You have a couple for us. I find both of them interesting.
I'll tell you what, Diane, if I didn't shock you in the A block, I'm going to shock you right now. So I've got 2 stocks that are down 80% off their 2021 peaks.
Okay.
And the first one is about as boring gets.
I know what it is. Tell the people.
This is the Kleenex of home standby generators. It's called Generac.
Riveting.
And Generac has a 75% share in this business. The problem is during COVID, they built up their inventories too much because they couldn't get parts.
Yeah.
And it looks like in Q1 was the trough. So they're working through those inventories. They were at 1.7 times normal inventories. They got down to 1.4 times. They think they're going to be normalized by early in the second half. They're going to be cash flow positive this year. And the thing about this company, first and foremost, because of the pessimism, they're trading at about 15 times. Their historic average multiple is about 30 times, so you're getting a huge discount in terms of the growth. And the runway ahead is monstrous. They only have 6% penetration. And you could say, well, does it get saturated at some point? People don't buy 2 generators for their house.
Right.
What they find is in the top states where they have the most penetration above 10%, they consistently have the biggest growth rates, because what happens is everyone has a generator, so everyone wants a generator. Whereas in the markets where they're underpenetrated, they say, well, none of my friends have a generator, so what do I need a generator for? This is going to continue. This company it could be, over the next 12 to 24 months, we think a double after being down 80%.
And that's because of it being down 80%. So is this also just like a summer play because of, I don't know, potential for just demand and power outages, et cetera? Is that what
Diane,
is part of this?
I'm going to bring you in as an analyst at our fund, because you hit the nail on the head. This company does well on the basis of weather events, and we just entered hurricane season from June through September. You get the power outages, and by the way, our grid has been underinvested for so many years that what you're seeing is, when I was growing up, power outage was an hour, 30 minutes.
Yeah.
Now, in some cases, they're 3 days, 4 days, 5 days.
In Texas, yeah.
And when that happens, even in Connecticut, it's crazy. When that happens, everyone goes out and buys a generator. So we're expecting above average weather events for the next 4 months. And if that's the case, that's going to be a further tailwind for Generac. We're going to see some acceleration. With rates lower, we're going to see the housing market start to come back, home building come back. That helps Generac as well. So there's a lot of pent-up demand with all the millennials, the young folks like you, 33, housing and family formation. You all are buying houses now that rates moderate. You're going to jump on that. You're going to want a generator, and that's what's going to come.
He's the millennial.
You find me a
I'm
bank
Gen
that's going to give me a loan, we can talk. I also got to talk about PayPal, though. You talk about millennials. Of course, this is like the Venmo season, if you will. Summertime, you're out with your friends. You pay for this pizza. I'll hit you back with that money later on. Let's talk about PayPal here, because that's one of your other picks on the day.
Yeah, this is probably one of the most hated stocks right now. Again, down 80%. Look, they've got 435 million users around the world. That's mind-boggling. 3 billion transactions. So why is everyone all up in arms? Number one, obviously they got ahead of themselves during COVID. The valuations were crazy. Right now, it's trading at 11 times forward earnings compared to its average historic multiple of 33 times. Yeah. This thing is a monster. So what happened is they did this acquisition called Braintree. And Braintree really ramped up the volume, but their margins are lower because you don't have as much juice as you have on the normal PayPal transactions. So analysts got worried that you were having margin contraction, but you were having... It's okay to have margin contraction as long as the bottom line keeps going up. And what they wanted it to go up at a certain percentage all the time. I'll take tons of extra volume as long as the bottom line goes up. And that's going to continue to happen. You have 2 other things. Dan Schulman is stepping down before the end of the year. So you have leadership uncertainty that will get resolved. They'll have someone good. And then you've got an activist also to catalyze with Elliott in the stock, Elliott Management. So they are good at extracting value. So I think there are a lot of things that can go right while everyone's looking at what can go wrong.
They are, unless, for lack of a better way of expressing it, the what could go wrong plays that you have, the ones that I guess you're not a fan of. Let's start with Oracle, which surprised me. You're going against the grain here. I mean, it's up on the day, continuing to extend its advance. Explain your thinking here.
Okay, so Oracle and Lilly, I mean, I never, we're not short these stocks, so let's be clear about that. I don't think this is the time to be short aggressively anything. However, we like things that are on sale. We don't like things that are marked up. And we think that after Oracle's earnings, they're now trading about 4 turns above their average historic multiple. They usually trade at 18, they're trading 22. And we just say, okay, let this thing breathe. It's a great quality business. We get that their cloud is growing, but see if there's a pullback before you get interested. You don't need to chase it up here after earnings is our view.
Yeah, and then Lilly as well, one of the other picks here, Eli Lilly. Similar multiple issue that you're taking?
Yeah, it's certainly a multiple issue. It's trading at 51 times, I think, relative to its average of 25 times. and it's on the hype around Mounjaro. So
that's what I was going to say. It has. I'm sorry to jump in. It has Mounjaro. Like, how would you go against this? I mean, these weight loss drugs are all the craze right now.
Yeah, there's no question. But obviously, they have competition from Ozempic and Wegovy, and the stock has moved up dramatically in anticipation of the approval for weight loss usage. Right now, it's being written off-label, but they want to get the weight loss usage. So two things could happen. Number one, you could get that approval and it's to sell the news because it's run up so much. Or number two, God forbid, which I think is very low probability, what if you didn't get that approval and it's already priced that in? So I think, again, I think the long-term runway is certainly good, Diane. I agree with you, but I don't want to pay up 2 times its average multiple. So for me, they're just a pass for now. It's not they're not great. They're both great businesses, but they're a little rich for me right now, just today.
Understand. We need a sale.
Yeah.
All right. We like that. We like a sale. Yeah. All right, Tom Hayes, thanks to you so much for this great
Diane.
conversation
Thanks, Brad.
today.
Appreciate it.
Well, the hospital sector getting a boost as a new survey shows revenue is growing in the post-pandemic environment. Yahoo Finance's Anjali Khemlani is here with the details. Hey, Anj.
Hey, so yeah, actually really good news. And this is coming off of some news yesterday that the health insurer, United Healthcare, was looking at an increase in outpatient utilization. And that is good news for the hospitals. Obviously have been suffering throughout the pandemic with a lot of their operations really curtailed or shut down as a result of all the safety procedures and the overwhelming use of critical areas for COVID-19. So what we see now is a note from Cowen saying that 2 of the last 3 months, that's March and May, reflect the highest calendar adjusted figures in their survey since December 2021. And if you look at that graph, it is basically like peak valley, starting with the valley in 2020 when things really bottomed out, a little bit on the upside in 2021, and then once again down into the negatives of revenue for 2022. So now they're just starting to eke up a little bit. May was an increase by 7.5% in revenue, so looking really good there and out, of course, of the negatives in that area. And this is good news for hospitals across the board, whether it's nonprofit or for-profit. And it's also going to really impact other sectors as well. In med tech, for example, which is where you get your surgical, devices, medical monitoring devices and the like, all of those are also going to be impacted. Meanwhile, the concern that came from yesterday's news on the insurers seems to have worn off. It was, by some analysts' measure, a bit of an overreaction to the news, considering that the measure being used or being focused on the MLR medical loss ratio wasn't going to be too greatly impacted by this utilization. But it does stand to be seen whether or not next year's prices and premiums will be affected by this increase in utilization. So that's where things stand right now.
Anjali, thanks so much for breaking that down for us here today. Yahoo Finance's own Anjali Khemlani. Well, coming up, May retail sales out this morning showing some resiliency in consumer spending. We break it down on the other side. Stick around.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Retail sales from May showing a sign of resiliency. Sales coming in higher than expected. However, the pace of growth cooling off amid the Federal Reserve's efforts to ease demand and lower inflation. Joining us now, we've got Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Michelle, we've been looking forward to this conversation all day. Just help us put some type of context on why this resiliency that we're seeing.
I think it is actually somewhat simple in that it has a lot to do with the labor market. When you think about the consumer and its ability to spend, it's dictated by its path of income. And we are seeing still labor market conditions that are strong. The last jobs report, surprised to the upside, showed quite robust hiring. Income growth is still running pretty strong. Wage growth is hovering at high levels relative to normal. So the consumer has purchasing power. And if the consumer has purchasing power, we're going to see it in terms of these retail sales numbers like we did this morning.
Michelle, Diane here. And speaking of the consumer purchasing power, one of the standouts was car sales. What do you make of that?
Yeah, that was a standout. That was a bit of a surprise because the recent trend had been weaker. And when you think about the Federal Reserve and what they're trying to do in terms of increasing interest rates, they're trying to transmit that tighter monetary policy through the interest-sensitive sectors, autos being one of them. And it looked like it was working. Auto sales had been weakening. And then this last month, it looked like it popped higher. And that followed on the CPI report that showed used car prices also rose. So we'll see if it's a trend. It may be, more noise than signal. I still believe, broadly speaking, that in an environment where interest rates are high and maybe increasing further, sectors like the housing market and autos are going to be a bit more problematic than in others where you don't necessarily have that same sensitivity to interest rates.
And Michelle, consumers know a few things right now. They know that things have been costing more over an extended period of time. They also know that there's some profit-led inflation that's also out in the water as well. We see that in discussion. But then they also know that the Fed is on a tightening pathway too. And to the extent that they factor that in, if at all, is that showing up? Is the average consumer on an everyday purchase sitting there thinking to themselves, you know what, I'm not going to buy this because Fed Chair Jay Powell, he's got some very hawkish tenor that's still in his conversation and on his lips?
Well, look, I think that to the extent that consumers are buying something that requires financing, you become much more sensitive. Think about if and when you purchased your home, you're following mortgage rates so closely because you want to try to, optimize your purchase in terms of the level of interest rates. So I think it depends on what kind of purchases you're making. But for the most part, for most consumers, it's that flow of income. It's the health of the labor market today, expectations for the health of the labor market tomorrow in terms of driving consumer spending. We have seen some greater sensitivity in terms of pricing. Overall inflationary pressures are starting to come down, which shows both on the supply side with the cost pressures being reduced, but also maybe on the demand side with consumers making a bit more choices and, trying to navigate what had been a very high inflationary environment. But I think, for me, focus again just on that labor market. That's going to be critical.
Michelle, I got to ask, so there definitely seemed to be overall more strength than expected and more strength than weakness. Was there anything concerning about the data to you?
Really not in this report. And when we look at, what we're seeing in terms of our spending pulse insights, the data that we're examining, we are also seeing a consumer that's out there spending. And particularly in things like experiences. So lodging spending is very strong. Restaurants are very strong in terms of spending growth. Travel is remaining quite robust. We recently published a pretty comprehensive report on global travel, which shows this extraordinary increase in travel across the world, not just here in the U.S. So I think for the most part, the consumer, is spending, maybe prioritizing certain types of items, but they have the ability to make those decisions right now.
Michelle, you have such a cool job, and I'll be honest, I'm kind of jealous sometimes because you've got access to this data, at least I perceive from the outside looking in, that a lot of people would love to just index or comb through, sift through to see how the consumer behavior is shifting at different times of economic cycles. And particularly as we think about what you were just saying with the services spending and the experience economy spending. If I go to a PGA Tour event, they're saying, hey, you can get X% off if you've got your MasterCard that you present. I wonder for what you're seeing within even some of those experiences where there might be some moderation out there, even inside of some of those services or experiences spends.
Yeah, well, I'll follow up on your first comment. I agree. I do think I have a pretty cool job as well. And a lot of that is because of the ability to leverage timely insights and timely data. I think right now, when you look at the broad experience category, there's still a very robust picture, double-digit growth in terms of year-over-year nominal spend. And I would say what's been really standing out is, as you noted, recreation type spending and lodging. Those have been really quite persistent. And it'll be interesting to see as we enter what has been historically quite a critical travel season into these summer months, how consumers continue to make the decisions around how they want to spend. And at the same time, of course, following the labor market trends in terms of their ability to go out and spend.
But is there as much demand from what you're seeing on the bookings and the swipes or, the card not present type of transactions that we're hearing from the airline CEOs, that we're hearing from the lodging CEOs, where they're looking out into later on this year and saying that demand is still counter-cyclical to the rest of the economic recovery?
Well, yeah, when we look at bookings, which to your point are going to be more forward-looking, we are seeing bookings trends hold up very strongly. So I can reference particularly for the U.S. So that suggests in terms of actual movement, we're going to continue to see that over the next few months. I think the trajectory forward will be a function in part of the macro environment. So, when you think about what's been happening in experience spending, it's the pent-up demand, but also the ability to spend. And that ability to spend has allowed consumers to over-prioritize experience spending, and in some cases, under-prioritize other types of spending, like some of these durable goods that have seen some pullback. So if and when there's a contraction in the spending power, if the economy were to weaken, if the labor market were to see a softer trajectory, then I do believe you're going to see some shifts even in experience-based spending. But right now, there is that prioritization that we see very clearly in what we're analyzing.
Michelle, always great to speak with you. Thanks so much for joining us here this afternoon and breaking down some of the trends that you're seeing over at MasterCard. Michelle Meyer, who is the MasterCard Economics Institute Chief U.S. Economist. Appreciate it.
You got it.
Switching gears, it got a little bit cheaper to buy a home this week. Mortgage rates ticking down for the second week in a row. The 30-year fix fell to 6.69% from 6.71% the prior week. Now, despite the dip, rates are still high, which has been a deterrent for many potential home buyers. But there may be good news on the horizon thanks to the Fed. Look, we saw a Fed pause yesterday, pausing its interest rate hike campaign, or skipping, as some might call it. While Fed Chair Powell signaled there could be more hikes ahead based on the dot plot, it seems the Fed may be near the end of the hiking cycle, which could give discouraged home buyers a chance to get back in the market. So, Brad, I do find this interesting. It has certainly where mortgage rates have been based on the numbers have held back buyers. I've been kind of a looker myself because of both the
market
level, quiet, not really, based on both the pricing that's still holding up here in the Northeast and the level of mortgage rates. So there's not really an incentive to get in there. I think so. It is good news personally to see that rates have come down, but not enough. And we have seen data that shows before that 6% is kind of that that trigger point that keeps people on the sidelines.
As long as you keep a tab open on your laptop, we will call you cautiously optimistic. Here's where we stand right now. The U.S. housing market, according to the National Association of Realtors, does need 300,000 more affordable homes for middle-income buyers. That's an amazingly important number to keep an eye on, even as more capacity does come online. It's not all the new homes that we should be focusing on. It's also who's listing some of their existing homes.
Agreed, personally.
Yes.
All right, let's stick with housing. Lennar crushing its second quarter earnings, blowing past Wall Street expectations amid housing supply woes. Yahoo Finance's Danny Romero has more on the biggest takeaways from the earnings call. Danny, take it away.
Lennar started its spring season with a bang. The earnings release really showcased that homebuyers aren't shying away from these higher interest rates that we just saw. I mean, I know we saw some easing, but there's still a lot of demand there. In this quarter, Lennar reported an accelerated housing starts. That is a really good gauge on how the home builder is really expecting and looking forward. It's also feeding into that housing appetite that's out there. The best performing markets were on the east and central regions. Some of those cities include Charlotte, Raleigh, Dallas, Houston, and you know, we pointed out the lack of homes, housing stock really offers Lennar some of those incentives to offer. So some of those closing cost assistance, some incentives, also rate buy downs to really drive up demand. But looking forward, Lennar is expecting to deliver between 68,000 and 70,000 homes this year, with home prices remaining pretty steady. But some Wall Street analysts are actually on the fence when it comes to Lennar's output compared to its peers like D.R. Horton, who are able to kind of grab the localized market and grow its volume. So that's something to look forward to look out for.
All right. Well, the Fed called out housing costs yesterday. They said they're still too high. So how did Lennar respond to this in their earnings call in terms of their rental business?
Yes. So Lennar has a multi-family rental business. Executives actually talked down their rental market because there is more supply out there. And so Lennar isn't expecting rents to come down too much. But other rental data shows that it's going to be a big challenge this year and next year for landlords and tenants, because the supply that's on the market is actually geared towards the higher end tenant, not necessarily tackling the affordable housing crunch that we are dealing with. So the Fed said yesterday that rental costs remain pretty high, and he said it signals to the policymakers that more needs to get done.
I think you just came up with the idea for a mascot for Lennar. Lamar.
I know, I noticed that.
Well, I mean, wouldn't you love to see a Lamar just dancing on the corner? Oh, it's Lennar out there again, Lamar.
All right, exactly.
I am a Lakers fan.
Okay, there we go. That's the Cali girl in you. All right, we're going to have to put a pin in our conversation. Danny Romero, thank you so much. Coming up, shares of Rivian riding higher today, and the company is expanding its retail footprint right here in New York City. We'll take you there. That's next.
Welcome back to Yahoo Finance Live. You know, in the world of retail and luxury, experiential is the new sort of concept that everyone's into. And so is Rivian. We're here at their new space in Williamsburg in Lower Manhattan. I'm joined by Denise Cherry, who is the head of retail here at Rivian. So Denise, talk to me about this space. What are you guys trying to do here?
Sure. I mean, I think what we're trying to do is set up a place for our community to be able to see and touch our vehicles. Like, we understand how hungry the customers are to see them and experience them. And we want to build a place not just for pre-order holders, but also for our owners.
So I took a tour of this facility here. I understand it's a temporary space while you guys get your new full space set up in Brooklyn.
Yep.
So right now you have the ability to sort of see where people are taking trips, what they're up to, and then sort of seeing some merch and things like that. Is that sort of the deal?
Yeah, and core to the experience here for us is trip planning and centering the experience around not just the product itself, but what the product enables you to do, right? To get out into the world, to connect with nature, to build your own adventure. And so that's why we've really focused in on trip planning as our core experience.
So, you know, you can order right now a Rivian truck on the app. You can do it all digitally. You can buy it online. You don't need to actually go anywhere. But do you guys find that you need this retail experiential experience to get more people excited?
Yeah, we think about it in terms of, I mean, there is just something that resonates with people in physical experience, right? You can see a video and you can hear someone talk about something, but for you to get into the car itself and to touch and feel the materials and to see how our brand and our mission come to life in physical space, there's just something that really builds a lasting relationship with our customers.
What has been sort of the early feedback you guys have been getting from these spaces?
Sure, I mean, I was here all last week when we pulled the paper down on this site, and people are literally banging down the door to get in. So I think that there's just an incredible interest, and we're super excited about it.
So this is a big year for Rivian, a lot of delivery and production figures that need to be hit that Wall Street wants to see. Are there any expectations for the retail operation? Like, what do they want to see from a lead generation or sales point of view?
Yeah, I mean, I think for us, it's really core about building our brand and building our awareness. And eventually that will lead to top of funnel, but we really just want to get people, meet our customers where they are, and get people super excited about being able to touch the product.
So I know there's a number of spaces planned. What are some of the big cities and big kind of like locations you want to be at?
Sure. Obviously, we've got New York. That was like our first one when we were doing this wave. We have our space in Venice that's open today. We're also planning Chicago, Vancouver, Seattle. Those will open very, very soon. And then we have some really incredible experiences planned slightly outside of major metropolitan. We have a charging outpost planned outside of Yosemite. So that will be an amenitized charging experience for people to be able to not just charge their Rivian, grab a snack, let your family relax, that kind of thing.
So you mentioned charging. A lot happening in that sort of the world right now. I imagine the charging will be an experience here at these spaces. Are you guys trying to make, like, I know you guys have the charging network, the Adventure Charging Network. Is it going to be focused on more lifestyle and have space for people to hang out? Is that the deal for future of charging for your Rivian?
For some of them. So for these charging outposts, absolutely. I think, you know, charging is one of the major sort of barriers for EV adoption. And so we want to do our part to be able to ensure that, like, our customers can go everywhere that they want to.
Do you think you'd ever have the Tesla NACS charging port at a Rivian space? Or?
I have no idea.
had to ask. But so, well, anyway, I want to talk to you about that. I think the Yosemite experience kind of struck me as a very interesting sort of, you know, we're talking about in the depths of nature.
Yeah.
You're going to have an actual facility there and a charge, right?
That's right. So we're super excited because we think about that as almost the physical manifestation of our brand. It will be an incredibly sustainably designed site. You will see, you know, passive cooling. It's a net zero building. A lot of real thought went into how we can make this space truly circular. And also, I mean, just it is an old gas station that we are converting into like the future of electrification, and we just think that's so compelling to who we are.
So from a future space build out, what do you envision? Do you see sort of trucks with the overlanding tents set up and people can kind of climb around and play in them? Or is it more of a spot to hang out and then also maybe have some of your partners whose books, backpacks, t-shirts, that sort of thing?
Both, eventually, hopefully both of those things. I think Groveland specifically is probably going to fall more into the latter, but there will be no shortage of Rivian owners, and I'm sure it will become a place where owners clubs will want to meet up before they head to Yosemite, and so it will still be able to build that community for us.
Well, I think I want to visit that Yosemite station when that's opened up. So Denise, Cherry, thanks so much for joining us. Wanted to clarify, we're actually in the meatpacking district of Manhattan. The next new facility will be in Williamsburg, Brooklyn.
Meantime, thank you so much, Praz. Let's stick with the auto sector, if you will. Shares of Carvana higher today. Gains persisting after a mix of last week's strong second quarter guidance and used car prices rising. So a little bit, partly surprised by this, not completely surprised by this, especially when we look at like the sales numbers we saw today, used car sales rising, looking at shares of Carvana up over double digits over the past couple days, extending their gains. But look, some analysts say, I mean, this stock is overvalued. So, but it's not playing out in terms of the numbers today. Investors joining in on Carvana. It's not just the risk on trade. I mean, one of the data points that we looked at recently, Brad, was about the amount of time people were holding on to their cars. And the data showed it was at a record at around 12 years now, which it used to be, I guess, 9 to 11 years. And 11 years was kind of unheard of. I've held on to my car is 8 years old. So I'm heading there. I think 7 or 8 years old, something like that.
Okay,
yes.
that's
so
solid.
I'm heading there. I've got the itch now. And but I don't know that I'm going to Carvana. But investors piling into that one today.
Yeah, and taking a look at, I'm glad we had the year-to-date view of this stock because it perfectly shows how much of a rebound has had to be necessary just for analysts to resume their coverage of this company. You look back to the year that was 2022 for Carvana. This was Yahoo Finance's worst performer of the year. And you're taking a look at kind of that longer-term scale and how far from grace this company has fallen. And so over the past 2 years, still down by about 90%. Still got a lot of work to get back into good graces of investors, but that's really going to come back into the resumption of when people are looking to get more of the hands on the used vehicles and when more used vehicles come onto the market as well.
Indeed, and also the interest rate environment.
Absolutely.
Yeah.
Well, since the beginning of 2022, construction spending on new factories has more than doubled, with the latest data showing $189 billion was spent in the last year. So what caused this jump? Yahoo Finance's Rick Newman, he's got his hard hat on. He's got this story. All right, he doesn't have his hard hat on. I didn't mean to purport that, Rick.
Hey, let me get my props lined up, man. Give me some fair warning. This is a pretty remarkable story that seems to be developing here, to be honest. Presidents going back 10, 15, 20 years have been trying to do this, which is establish more domestic manufacturing, create incentives for companies to build more stuff in the United States and if possible, relocate some of their factories from overseas back to the United States. That's known as reshoring. That's been a buzzword for a decade or more. President Obama tried to do it, didn't really work. President Trump tried to do it, didn't really work. Now it seems to be happening under President Obama, and we're seeing this in the data for the construction of manufacturing facilities, as you pointed out, Brad. It is booming. It is up by the most ever on record in data going back to 2002. And as a percentage of all construction activity, manufacturing construction is now the highest as a percentage of all activity since 1993. And that's when those records begin. So something big is happening here. And it almost certainly is related to 3 big bills that Democrats passed when they controlled Congress during Obama's first 2 years that Obama signed. It was that big infrastructure bill in 2021. And then in 2022, we had the CHIPS Act for semiconductors and the Inflation Reduction Act with green energy incentives. Companies really are responding to that. In fact, there's been other reporting showing that the companies that are trying to cash in on those green energy tax breaks they're doing that at a much higher rate than the budgeters in Congress expected to happen. So that could end up actually costing more money because more people want the tax breaks. But what this probably all means is we're going to see a real surge in manufacturing employment in the near future. We haven't seen it yet, but that's because these factories are being built now. Soon they're going to start operating and they're going to start hiring people.
And we'll see what type of manufacturing they're doing as well, especially with a lot of focus on chips as well going forward from here, Rick, among many other industries. Rick Newman, thanks so much for breaking this down.
Bye, guys.
Appreciate it. Coming up, we've got the closing bell on Wall Street. We'll get you caught up with some of the trending tickers and today's top stories. Stick around. Major averages still in positive territory. 5 minutes left in trade.
No change. The Federal Reserve holding rates steady in the current range of 5 to 5.25%, but raising interest rate projections to a new peak of 5.6%, implying at least one more rate hike from here.
I think this is very hawkish. I mean, the idea that the dot plots have moved up to include about 2 more rate hikes coming from the Fed. I think now you're going to start to see markets maybe projecting maybe 50 basis points at the July meeting to get us there. I don't think they need to keep raising rates. I think they should be done.
The Fed is sending a little bit of a hawkish pause here, and in that sense, I think it confirms the market's expectation. I think the key here is what does Chairman Powell say from the podium?
If this is in fact a hawkish pause, we would expect to see potentially a stronger dollar along with yields going up, and that's what's been happening here. We're still waiting for Powell to take the podium, and that's really when we see the fireworks.
Fed Chair Powell saying that the Fed has not made enough progress on inflation. It needs to come decisively lower, and that's why the committee sees 50 basis points more of rate hikes here.
I didn't anticipate that the Fed would come out and do something different because they don't want to cause that extra volatility in the markets. However, at the press conference, I don't think we got a very clear answer as to what the goal was going forward.
It seemed to mainly be about a couple of things for me. One, slowing the pace. He said that a bunch of times. And then the other thing is to hold the threat of rate hikes over the market for longer. Putting 2 hikes in the baseline essentially takes us through year end at this new slower pace.
Most FOMC members, each dot represents a member here. They see interest rates peaking at 5.6% this year. Now that's higher from the March projection of 5.1%. So that does suggest that the Fed is going to raise rates 2 more times by 25 basis points, or perhaps 1 time by just 50 basis points here.
We're taking a live look at the floor of the New York Stock Exchange, where the clock has struck 4 p.m. You know what that means, folks? Done with the cash trading here on the day. We now move into the after hours activity where things are about to get on and popping for one Adobe. We're going to be watching that company, but also taking a look at shares of, well, actually taking a look at the U.S. major averages. Let's start there. Dow Jones Industrial Average. That closes higher by 1.25%. We'll round that off to 1.3% if you want to be generous at home. S&P 500, you're seeing that close higher by about 1.2%. Nasdaq Composite, that closes higher by a little more than 1.1% on the day. Let's check in on some of today's top trending stories. Got to start with Kava on the day. Closes higher by nearly 100%, 97.84% to be exact.
Yes.
After making its public debut this morning, originally pricing at $22 a share. Closes at $43.52 on its initial public offering day here. And Yahoo Finance's Brooke De Palma has been following the stock and joins us now for more. Hey, Brooke, you were on the floor of the exchange.
I was on the floor of the exchange, and the excitement, the roar, the foot traffic there was honestly something that we haven't seen in quite some time. We know that prior to this debut, the stock was priced in about $22 as of Wednesday evening. Shares of Kava opened up at $42 this morning, popping, as we see here, more than 100% from that original price. Now, prior to this IPO, many compared this to Sweetgreen, a company that one of the last food companies to go public back in 2021. Their shares too popped on their IPO day, up to $52 per share, originally priced at $28 per share. And now, as you see here, shares are priced in at got a bit of a boost in midday trading today, but priced in about $11, $10.42 closing right now. But Kava here, they're saying that they're focused on their long-term vision. And earlier today, as we noted, we spoke with CEO Brett Schulman at the New York Stock Exchange and asked if he was worried that the valuation was perhaps too high here. Here's what he had to say.
I told the team last night, we're not going to focus on the daily stock price. Markets go up, markets go down. We're focused on the same thing we've been since we started, which is our long-term vision of defining the Mediterranean category and bringing the Mediterranean way to communities across the country.
And right now, the company is really heavily investing in that long-term vision. They have plans to open 1,000 locations by 2032. That's a total location amount. Now, this is also a fast casual chain. So think something like Chipotle's concept. It comes at a bit more of a premium price. And here at Yahoo Finance, we're covering heavily just how much the consumer has been heavily affected by the height of inflation. And so we asked Brett, who exactly is your customer, and how do you attract customers to give Kava a try? Here's what he had to say about that.
When you look at our gender mix, 55% female, 45% male, great generational mix, and great income mix. You know, we're able to compete down income brackets because of our value proposition. And one thing we did to lean into that value proposition, I talked about that infrastructure we've invested in over the years. That now allows us to really leverage into in the business and not have to raise price as much as maybe some of our peers have.
And he went on to say that last year the company raised prices by 5%. He told Yahoo Finance there are no plans to raise prices again for the remainder of the year. But profitability still the key question here for Kava, as it is for Sweetgreen. He says that he continues to remain focused on the long-term growth, and they have a tremendous unit economic profit here. I mean, big plans for Kava had certainly the company using this capital raise today in order to invest in those new restaurant openings. And so a story that may just be beginning, even though they opened their first fast casual concept back in 2011.
Yeah, and I mean, it's clear investors are willing to be more than patient with the way they're piling into Kava today, given its path to profitability, if you will, and given that their loss widened last year. So we'll see what happens if it's the beginning of a great new thing for Kava, or if it's a dine and ditch kind of situation. I don't know.
I mean, we'll see, because foot traffic at Kava is doing well so far this year. I mean, people really like these fast casual concepts.
They do. All right, let's stay kind of in the food and beverage space, but brought it out to grocers. Shares of Kroger under some pressure today, closing down more than 2.5% after some lackluster sales numbers. Also an issue with guidance from the grocery store giant. Revenue came in under Wall Street estimates. Profit beat, though. Chief Executive Rodney McMullen pointed to lower income shoppers making changes to how they buy food, including buying fewer items and cheaper products. So a little bit of a trade down, including smaller packages, partly because of declines in food stamp benefits. So one of the issues it seemed that was Kroger seemed to have was others raising guidance, and they're like, we're just reaffirming our forecast. And basically, it's like Wall Street's like, what have you done for me lately?
Yeah, spot on. I mean, the first quarter results, they said that it demonstrates the durability of their business model in a more challenging operating environment. You got to wonder if they're seeing some moderation in purchases among certain SKUs within the business as well, even as we've continued to talk about and monitor a trade down environment for consumers on some aisles of the grocery store.
Right. Well, when you think about that, you also have to think about what we've heard from Walmart. They're gaining higher income shoppers, and Kroger is saying the same thing on their call today, that they're seeing higher income customer households migrate from specialty retailers to Kroger. And what that means is those higher income households are buying more, they're spending more, they're looking at more big ticket items. And so certainly something to keep a lookout. Of course, Kroger was one of those darlings of the pandemic that saw so many customers flock to it as people bulked up at home, as people rediscovered the excitement of cooking at home. Maybe not for everyone, but really just a story to watch as well.
And a little bit of an inflation situation there with the higher income customers. We saw that with Walmart as well.
This is big time cooking at home season. Let's be real. Go outside, fire up the
Is this
grill.
a cooking show now?
It can be. It very easily can. You tell us.
As long as we're not talking about eggflation, I'm all good.
Viewers, tell us what you want. If you want this to be a cooking show, light us up on Twitter. All right.
I can cook.
Yes. I mean, look, fire up the grill. I'm ready to go. Grill master here. Thank you so much, Brooke. All right. Let's talk about shares of Microsoft here on the day. Ticker symbol MSFT. Closing the day over $348. That is an all-time high, beating the previous high of $343.11. That was hit on November 19th of 2021. 6 straight sessions here of gains for the tech giant. And you think about what it's taken to get to this point, not just coming off of the back of earnings and, of course, the fervor around FOMO in AI right now, but additionally from Microsoft, just looking across the broader environment, figuring out who in this market right now is best positioned to deploy capital to continue to invest in some of the generative AI ambitions. Microsoft, of course, one of the
leaders,
the leader play.
I mean,
in terms of the $10 billion that they allocated for OpenAI,
exactly,
and pushing that into their Bing product. But now, even if there are some of the companies that investors continue to cozy up to in this AI FOMO trade, it's going to be the ones perhaps that have the most cash to deploy towards it right now.
They have the cash, and they're also, in terms of their market cap, chasing NVIDIA. I mean, they're at about 2.6 trillion now for Microsoft. So, they're hot on their heels. They are that not just OpenAI, the generative AI play right now. So investors piling back into that one as well.
And they have the client base, too.
Yes.
They have the cloud client base for sure here. Let's also talk about Tesla here on the day. We've been watching this one. Tesla shares closing the day lower. Back to life, back to reality, back-to-back losses here. After the EV giant saw 13 straight days of gains. Look, it was a hot streak. Earlier this week, Bank of America analysts, though, they estimated that the U.S. electric vehicles market will drop to 18% by 2026. For more on the EV space, we welcome in Ross Gerber, Kawasaki Wealth Investment Management CEO. Ross, great to speak with you here today. Even as we kind of look at this win streak that Tesla has had, you have been one of the more vocal names around Tesla shares, whether it's thinking that Elon Musk should give up the reins to somebody else, or whether it's just how they're able to make sure that they're locking in margins for the longer term. You look at a win streak like we saw, net happy, net sad that it's snapped. What goes through your mind?
Well, I'm certainly not sad when you own 420,000 shares of Tesla that have it go up substantially and make my clients, I don't know, $50 million, pretty happy. So, just to be clear, I didn't want any change in Tesla's management. I wanted change in Twitter's management, which is what we got. And by getting Elon back at Tesla and all the moves they've made just in the 30 days since Elon's really been refocused on Tesla, with signing up the entire world to the Tesla charging infrastructure, for example, and having a very, very positive meetings in China, we just have seen full-fledged how Elon's focus makes such a huge difference in the results. And the stock market has responded, and institutional investors have come back into the stock, and now we're back to the valuation that Tesla deserves.
So, Ross, Diane here. With regard to both of you, had been bullish on Tesla way before the rest of the market has caught up. But previously you were pushing for a board seat. Are you happy with how Tesla is being run now?
Well, I mean, pretty much everything I was pushing for, they've done. So, yeah, I'm thrilled. Once again, Tesla was never really against any of the ideas that I was presenting. It was really just Elon. And so I think there was just a period of time that it took for several of these things to sort of percolate into his mind, into existence. And now things are moving in very much the direction that I had hoped. I feel a lot more confident about the succession plan and management. The changes in the board with JB Straubel, I was very much for. So I'm happy to have JB and Tom Zhu on the board, which really represent operational, players for Tesla, but also just the investor day I thought was super illuminating, followed by a shareholder day that was also very illuminating to what's happening with the company and their focus. So when you look at Tesla as a whole, obviously there's many challenges they face over the next year, but with Cybertruck launch imminent and the economy hopefully looking like we're through the worst of it and of the rate cycle hike. So hopefully we won't have a recession, and going into 2024, you have to be very bullish on EV makers like Tesla.
We've heard some on the street call out and say that Tesla is now an AI play. Do you believe that to be true? And has Tesla disclosed enough of how much it's willing to spend on artificial intelligence at this point for you?
Well, it's really nice that everybody's into AI, but this has been going on for a long time. AI development, NVIDIA is another top investment in my fund, GK, along with Tesla is our top investment. And so it's been a really good year for us at GK. But, when you look at Tesla, it is an AI company where its solution, it's not only an AI company, but its solution is autonomy or having cars drive themselves. So this is a much more difficult AI solution than, let's say, generative AI, getting it to tell you, how many, stocks are in the S&P 500 or something, which is 500. So, it's kind of like the market's finally realizing the full value of the software that they've been developing for a long time, that a lot of people have been saying is going to be incredibly valuable. Now I think the market's starting to say, hey, you know what? These cars do drive themselves, and that could be awesome.
You mentioned the Cybertruck earlier, but that has been delay after delay. Is it ever going to come?
Well, we don't look at Tesla timelines as delays. That would assume that the original date was actually real. So we look at Tesla when they set timelines as really goals. So they haven't achieved their goal in reaching production as quickly as we had hoped, but they're certainly reaching it now. So we're now at the beginning of, can they make these in scale, and how much pain will they go through making these in scale? And we'll see in the next probably 3 to 6 months how successful they'll be at scaling Cybertruck production. So we're hoping for the best. And I was just in Austin, and they're employing incredible new technologies to build this truck. So it'll be quite a challenge. So it's great to have Elon back on the factory floor, really working at Tesla.
Well, I like the vehicles. I'm on the fence about the Cybertruck, but thank you so much for joining us, Ross Gerber. We appreciate your insight as per usual.
Thank you.
Coming up, earnings from software giant Adobe, hot off the press. You're looking at them pop in after hours. We've got the numbers on the other side. Stay with us.
Shares of Adobe trading higher in after-hours trading by nearly 4% here as the company just reported earnings here. Taking a look at some of the figures that the company has announced for its fiscal second quarter of 2023. Achieved revenue of $4.82 billion, and then EPS on an adjusted basis came in at $3.91 a share. Looking into some of the quick takeaways here, at least on the digital media and creative cloud side here, Creative Cloud being a part of their digital media segment. They beat on both of those expectations, essentially. That is basically the largest part of the business, the digital media part of the business. And so that came in at $3.51 billion. The street was looking for about 3.47, if you want to round it off that way, $billion here. That represents about 10% year over year growth.
And they beat the whisper number too, because the whisper number was $3.83 a share for EPS. So they beat that as well. So that certainly you're seeing them be rewarded a little bit in after hours trade. So we'll put a pin in that and keep watching Adobe, see how it performs after hours and even into tomorrow. Meantime, hackers have hit the Fed. U.S. federal agencies have seen a number of cyber attacks in recent weeks, and the Cybersecurity and Infrastructure Security Agency, or the CISA, is working to prevent any more issues getting through the cracks. For more, let's bring in Yahoo Finance's Dan Howley. Dan?
That's right, Dan. We're talking about a kind of ransomware attack that's going through this company, Progress Software, and its Move It platform. The guess is that this has to do with a potential ransomware gang called CLOP. There's no real confirmation as to whether it is or isn't that organization, but they have been attacking businesses as of late using that kind of vulnerability. However, when these kinds of vulnerabilities get out there into the wild, then any kind of organization can really take hold of it and start exploiting it in any way they want. So just to caveat it with that. Now, this is basically a report that CNN originally put out saying that potentially a number of government organizations have been impacted by this. CISA then talked to CNN, basically saying that they're working with federal agencies to remediate the issue, though they wouldn't say how many agencies, what particular information may have been compromised. Basically the who, what, where, when, and why of it not being released just yet. Not to say that it's not coming, but just yet. These kinds of breaches can be a big deal. We had the SolarWinds breach a few years back. That was a major issue for government organizations as well as private organizations. So, anytime we hear of this kind of issue, CISA gets involved, the FBI gets involved, different organizations will look towards how to stop this and who's responsible. But, a lot of times these gangs can end up moving around, joining different groups. They hide themselves very well. So we'll just have to see if CISA is able to provide us with any more information in the coming days, or if Progressive Software would be able to do that.
All right, Dan, thank you so much for that insight. We appreciate it.
Accenture betting big on artificial intelligence. The consulting giant announcing this week it will invest $3 billion over 3 years and doubling its AI-focused staff to 80,000. Joining us now is Paul Daugherty, who is the Accenture Chief Technology Officer. Paul, great to have you here with us today. All right, so walk us into this investment, what went behind the decision, and what kind of demand have you been hearing from the clients that you consult with as well about how they can best equip their workforce, their operations for the inclusion of AI?
Yeah, thanks for having me on the program. Our business at Accenture is all about helping companies transform and reinvent themselves using technology. And as you say, no technology is hotter right now than generative AI. We've been doing work in artificial intelligence for many years and have a significant business around it. But generative AI really is a step change in capability, allowing our companies, our clients to do many new things. And that's what's behind our investment. We've had over 500 client conversations in the last couple of months on generative AI. It's hard to have a conversation on anything right now without generative AI being part of it. And in those conversations, we hear about the interest our clients have, but also about some of the challenges in adopting the technology. 98% of executives tell us that generative AI is important to their strategy. 51% believe it's a game changer for their strategy, and 45% plan to spend a significant amount of their budget on it in the next 2 years. But they're unsure of how to get started. They're concerned about some of the risks. They need to look at how they get their platforms in place to be able to deploy it. And that's why we're making the $3 billion investment, the big investment for us that we talked about. It's investment to help companies deploy generative AI more quickly. So we're doubling our workforce, as you said, from 40,000 to 80,000 data and AI professionals. As part of that, we have a Center for Advanced AI focused just on generative AI with 1,600 people focused on this part of the technology. We're developing a new capability that we call the AI Navigator for Enterprise, which breaks down the potential deeply into specific industry segments, 19 industry segments, looking at where clients can get the value, what types of models you need, how you get the data, and how you develop the business case and the processes to deploy the technology more quickly. And finally, the investment's focused on areas of responsible AI, because there's regulation is one of the questions. There's risks in deploying the technology. There's the hallucination and other issues that need to be dealt with. So responsible AI is really critical as we enter this next stage of AI's development.
Paul, Diane here. Speaking of responsible AI, one of the concerns about the use of generative AI is the potential impact to the workforce. Did any of those concerns come up in conversation? I mean, you all are investing in it. You're growing your workforce, but it's a concern outside of what you all are doing. Can you speak to that?
Yeah, we've done research on that shows 40% of working hours across industries, 40% of working hours will be impacted by generative AI. That doesn't mean, though, that 40% of jobs go away. Far from it. What you have to do is look under how generative AI will be used. So if you're in a customer support organization, you still need to answer calls, but you'll use generative AI to get better, deeper information, to answer calls with better quality and answer them more quickly, increasing productivity and better customer satisfaction. So it's about how do you deploy co-pilot type of capability using generative AI paired with the human plus machine type of approach to drive more productivity in that sense. So that's the type of impact that we see, and we believe that the secret to this is really looking at your business, looking at the processes you have, and investing in the areas that are going to help people do their jobs more effectively. And at the heart of it, one of the things we've been talking to companies about is we believe those that really win in applying the technology are those that probably invest more in the people and the change required than the generative AI technology itself.
Paul, at what point do you believe that we will see artificial intelligence as some type of input into the employment situation?
Well, I think it's, there's three benefits, generally speaking, that we look at for generative AI for business. The first is productivity that I talked about a minute ago. And I think there's tremendous possibility to get people job ready more quickly and give them, complement their skills using generative AI, capabilities to help them, enter the workforce or help them get additional skills more quickly. So that's one thing we see happening already that we're doing with our workforce. A second area is around using generative AI for growth, which will then generate, jobs and other impacts. And that's an area where we see tremendous interest for companies looking at generative AI to develop new products and services. For example, a media organization that's looking at an entirely new source of revenue and class of products they can develop using generative AI that they couldn't do without it. We're looking at organizations that we can help develop better sales and marketing tools to grow their business more effectively.
But does that mean we just get to a point of just pushing prompts all the time, just prompting something to be generated? And then how does that actually perhaps replace how companies thinking about the value of the human side of that too, and what compensation looks like?
Yeah, well, I think it's well beyond the prompt engineering, prompts and prompt engineering. I think that's one element of it, but it really, the way we see it in action as we work with the technology, it kind of enriches and allows the people to do more. And again, a customer service organization, the agent is able to deal with more complex problems and answer more effectively. So their skill level actually goes up. Their ability to handle more complex cases goes up. So it increases the human capability and it allows them to acquire new skills more quickly. And I think this kind of human plus machine and additive effect is what we expect to see more of as we look at the rollout of generative AI.
Paul, really interesting stuff. Thanks so much for joining us here today. Paul Daugherty, who is here with us and breaking down where Accenture is making its latest investments into generative AI. Appreciate it.
Thank you.
Coming up, Bitcoin below 25,000 for the first time since March. It struck that today. Right now, back above it by a little itty bitty bit. We take a dive into the world of crypto on the other side. Stick around. Bonjour. The French Riviera may be famed for playing host to an annual star-studded film festival, beautiful aquatic scenery, and fine cuisine. But for 1 week, hundreds of billions of advertising dollars are at stake. It's the biggest gathering in marketing, media, and tech space. Cannes Lions and Yahoo Finance will be there, talking with C-suite execs from the household brands we all know and love. We'll also speak with some of the biggest profiles in entertainment, such as Cannes Lions 2023 Entertainment Person of the Year, Kevin Hart. Plus, international music artist and producer, will.i.am. 3 big themes coming your way. 1, generating demand during a discretionary spending downturn. 2, leading a values-driven brand through a polarized society. And 3, the role of artificial intelligence in advertising. Join us at the Cannes Lions Festival all week on Yahoo Finance.
Taking a look at crypto, Bitcoin in particular. It's been fluctuating today, a little up, a little down. It dropped below 25,000 for the first time since March this morning, but got a boost following news from BlackRock. It's being reported that the world's biggest asset manager is close to making an application to create a Bitcoin ETF, and it will use Coinbase for the market data. Now that comes as the digital finance world faces much broader issues, with the SEC filing lawsuit after lawsuit throughout this year, the latest being against Binance and Coinbase, calling into question the regulation around several popular coins, deeming them crypto asset securities. Here to discuss more is Scott Melker, the host of the podcast Wolf of All Streets, not just Wall Street, all streets. All right, Scott, let's get into it. First, let's talk about kind of BlackRock coming into this picture. We've heard buzz about this before. What does this say to you about the state of crypto, Bitcoin in general? Is it becoming even more mainstream with that kind of news?
I think it has been becoming more mainstream for quite a long time. And this isn't BlackRock's first foray into the space. They've already been working with Coinbase to allow their high net worth clients to have access to Bitcoin and other crypto assets. So there's nothing really new here. Listen, after the FTX collapse, I actually sent a tweet out that said, watch, Wall Street's about to sweep in and buy up our industry for pennies on the dollar. And it seems that what we have now is legislators and regulators pushing this industry into the comfortable hands of Wall Street and getting rid of the crypto incumbents like Coinbase and Binance that they view as a threat. So as good as this may be for institutional adoption of the space, it kind of violates the ethos and is a bit of a dishonest push away from the people who actually built the crypto industry in the United States. We've already seen a number of spot ETFs rejected over and over and over again. It's being litigated with Grayscale in the courts right now against the SEC. I wouldn't be surprised to now see BlackRock move from back of the line to the very front very quickly.
Right, and so that's what I was going to ask, actually. When it comes to some of the Bitcoin ETFs that we've already seen filed for review and approval, we've seen it for multiple years. They get filed, there's a hefty comment period, it essentially just ends up on the cutting room floor somewhere or just kind of gets held in obscurity or purgatory, whichever way you want to look at it. At the end of the day, you've got companies like Gemini, Van Eck, Grayscale as well that have put one forward. So if you see a BlackRock now moving forward with this, aren't they destined to take some type of legal action unless BlackRock's is, I guess, materially different?
I would think so, but legal action and crypto go hand in hand at this point. I think we can see that we've seen regulators coming after the crypto industry going after the regulators. So yes, I think that would be par for the course. I can't imagine how they can justify approving a BlackRock ETF without the others. And as I mentioned, Grayscale is currently in litigation to get their GBTC Bitcoin Trust moved and transferred and converted into an ETF, which has been strangely rejected. There's no rational reason that we should not have a spot ETF for Bitcoin. That would actually protect consumers, which is the mandate of the SEC. It would be a great move forward. But they gave us a futures ETF, which is an inferior product that was approved, a year and a half ago. We have a couple of those that basically just don't track spot accurately and are much worse for the consumers. So it's a real head scratcher why this hasn't happened. And I think it's just because of the activist approach that the SEC is taking towards the crypto industry.
So speaking of the SEC versus crypto, the SEC is coming down hard, cracking down on the industry. You have these lawsuits, whether we're talking about Binance or Coinbase. And one of the pieces that the heart of the issue is also the question of whether we're talking about a security or crypto as a security. What do you think about how the SEC is coming after the industry? Is this fair?
It's absolutely not fair. Gary Gensler needs to be fired immediately. And you've actually seen that the hashtag Fire Gary Gensler is trending, partially because of myself, partially because of my show, the Crypto Town Hall on Twitter Spaces. It's the biggest show in the world. We had Warren Davidson on, who's also been tweeting Fire Gary Gensler and has put forward the SEC Stabilization Act to do just that. Listen, Gary Gensler is embarrassed about his relationship with Sam Bankman-Fried, that he platformed FTX, was working with them on regulation, that he was going to give them a pass outside of this legislation that they were going to pass. And so he's embarrassed, and he's overcorrecting massively in the opposite direction, trying to take an activist approach against the entire industry. It's absurd. It's unfair. It's probably illegal, and that will also be litigated in court. But the SEC is way out over their skis. It's Congress's job to determine what these assets are. And Gary Gensler can't even sit on the Congress floor and give the simple answer of whether Ethereum is a commodity or security when that question is pointed directly at him repeatedly. He refuses to give guidance because he would rather be vague and then just go ahead and deem everything a security without actually going after any of those platforms and protocols. It's completely absurd, and he needs to go.
So if he were to leave, then who would you want to see in leadership there?
Well, it's hard to know if the replacement would be better, but we know what we're working with, and we know that he's not acting in good faith. There are SEC commissioners who are extremely rational and have been in favor of freedom and doing the right thing for years. Hester Peirce is one of them. She's proposed for years the idea of safe harbor, which would allow any project to come in, register with the SEC, and they would have a 3-year period to prove that they're sufficiently decentralized and no longer a security before they can launch and be listed. That is an extremely sensible approach, the way that this should be viewed. We shouldn't be using the Howey test and securities laws from the 1930s and 40s to apply to digital assets that obviously just do not fit inside that framework. So yes, part of this is actually that Congress needs to act. They need to put a framework in place. And if you were to defend Gary Gensler, you would say that because the only tool that he has is a hammer, everything looks like a nail. But we all know, like I said, that he's overcorrecting because of his relationship with Sam Bankman-Fried, because there's egg on the face of legislators and regulators because of their relationship with him, and now retroactively punishing people for the actions of bad actors last year. Listen, do you think that the mandate of the SEC, which is to protect consumers, do you think they're doing that when they put out these actions and just list a bunch of random coins as securities without actually deeming why or going after them? And then those coins crash 30%, which many Americans are holding. Americans are losing money because of the actions of the SEC every single day.
Even as you're laying out how you would like to see crypto regulated right now, too, and I guess as we figure out who would be the person to decide that regulation if Gary Gensler, to your, I guess, what you would like to see, if he gets removed at the end of the day, then from here on out, it's a question of if this BlackRock ETF goes forward, then clearly it's a security, probably. And then on the other side of that, what other regulation is there? Know your customer rules that you believe should be added on in addition to safe harbor? Like what are 3 things that you would like to see in regulation in crypto?
Sure. Well, you could say that the ETF itself will be a security, but Bitcoin is actually the one thing that is very clearly a commodity, and nobody is arguing over whether or not it is security. So it seems somewhat safe and largely under the purview of the CFTC. Safe harbor is a very reasonable thing. I think that we should see some of the great ideas that were proposed in the Lummis-Gillibrand bill last year, which apparently is coming back leaner and meaner, some stablecoin regulation, how stablecoins should be allowed to be backed, because those are one of the killer use cases of crypto. KYC AML is already a huge thing in the crypto space. That problem has largely been solved. I can tell you that Americans largely are not able to register on platforms like Binance that are overseas. These are things that they're being accused of from 2018, 2019, when those things were much easier. The fact is, there's never been regulatory guidance in almost any jurisdiction for this industry. So it was either get started and then come into compliance or do nothing at all. And I think that most of these companies, platforms, exchanges are trying to do the right thing now when it's very obvious. They have the eyes of the world on them. They're not trying to, participate in illegal activity and do things that are non-compliant. So I would say absolutely KYC, AML are very, very important for these exchanges. Safe harbor is an exemplary idea, and getting some definition of what's a commodity and what's a security would certainly help.
Just very quickly, we got to go. Is Robinhood next? We've already seen Coinbase. We've already seen Binance get under the spotlight of the SEC. Is Robinhood next?
I'm terrible with my crystal ball, and I don't like to guess who might likely be next, but I will say Robinhood is clearly getting ahead of this by delisting the very coins that were listed as securities in the Binance and Coinbase suits. Binance and Coinbase are really crypto-based platforms. Robinhood is a part of their business. So if anything, I would see maybe Robinhood sadly scaling back on that part of their business and coming into compliance, but I don't think that they'll see the same type of action that Binance and Coinbase and others are likely to see.
All right, we will have to leave it there. Scott Melker, we appreciate all of your insight and deep dive into the world of crypto. The Wolf of All Streets host, Scott Melker, thank you.
Thank you.
Adobe out with a beat on the top and bottom line in its latest earnings report, while also showing a boost to its revenue forecast. Adobe CEO also noting the company's position to lead the new era of generative AI. For more on Adobe's performance, we have Jefferies senior analyst Brent Thill. Hey, Brent, good to see you. As you kind of look through some of the numbers here, the results, and even how they're guiding and what they're saying around that guidance too. We were all kind of hotkeying for generative AI at the end of the day. Let's be real. I mean, do they have what it takes to perhaps woo the market and woo investors on their efforts in generative AI?
Yeah, the jury's still out on AI. I think many on Wall Street think Adobe is going to be hurt on number of users, as if you can reduce the number of creative users building something, how many Adobe seats are you going to need? So that's a long-term discussion. Short-term, they definitely scared the grizzly bears away. We think this is a great print, beat and raise. There's been this ongoing concern the creative business is decaying. The biggest beat inside the business is out of the creative business. And I think the death of Adobe because of AI is just completely over-exaggerated. So we think, Adobe has been showing AI for many years. Investors seem to not been listening to them. And so all the bears in camp are like, AI is going to crush them. And we're not seeing that. I think long-term, the debate is still out there. Obviously, we still have to get the Figma deal closed, which they overspent, $20 billion, but will certainly help their creative process if they get this closed. And then, all eyes, once we get past that, are going to turn to Canva, which is, a threat at the low end of the market. But as we like to say, great stocks have great controversy, and Adobe's had great controversy. We're very bullish, and we think ultimately the good news is when you do the work, you talk to the users, the creatives aren't running away from Adobe. They're embracing Adobe. Yes, they're going to use companies like Midjourney, which are great AI tools to help them in the creative process, but they're not going to not use Adobe at this point. So we still think the story has legs. Now you have the stock up over 45% year to date. That's our only concern given the magnitude of the recent run back. But yeah, the grizzly bears are scared out of camp in the short term here.
So you have a price target of over $500 a share. I lost the exact number there, $530 a share. It's a ways away from that. Do you think today's results or the results released today will get you there?
Yeah, I mean, it's not a ways away. I mean, we're not that far. It's breaking 500 in the after hours. So I don't believe that's an issue at all. We've continued to have a bullish stance on Adobe since the stock was $30.
Oh, wow.
So we continue to believe, when you think about, there's been a lot of controversy short term about AI, and that's been the big overhang. The same controversy existed way back when Steve Jobs was alive, bashing Adobe, Flash, saying Flash is dead. Never thought Adobe was dead, and that wasn't the case, and the stock was 30. And so this company has incredible resilience, has incredible leadership. There are very few companies that can generate double-digit revenue growth and generate a 45% margin, have the quality of this management team. I've always said that this is a company that has an incredible team, and the users love their product. And most of the users we talk to would pay 10x for their products. I don't follow that many stories that have that type of surrounding in terms of the sentiment around the name. So huge admiration for what they're doing, what they've done. And again, I love the controversy because I think we've been able to prove that AI is not gonna run them off the road.
What are you looking for to hear from the executives today?
I think, everyone's worried about the economy, and ultimately, is there an economic boogeyman that's going to jump out of the bushes and scare everyone? And that's been the concern for tech since the beginning of the year. And the economists have been right that things are slowing, but I think Wall Street's been wrong that things are going to fall off a cliff. They haven't fallen off a cliff. In many ways, Adobe's business has gotten stronger now in the second quarter than even the last quarter. So overall tone about the back half of the year, their digital experience business wasn't quite as good. So we're keeping an eye on that in terms of the guide. But overall tone, I think of overall business and then AI are the two big things we're watching.
Brent, I want to switch gears here. We've been keeping tabs on Microsoft, of course, closing at a new all-time closing high for Microsoft, moved higher by a little more than 3% during today's trading activity. And over the course of this year, holding on to gains of about 45%. One of the mega cap tech companies that first really generated a lot of fanfare for its investment in OpenAI and kind of kicked off this FOMO trade, if you will, within generative AI as well. Where do you believe the stock goes from here? I mean, is this just a continued trend that we can expect for the near term while the melt up, while the FOMO trade continues to be tossed around?
Stock's going higher. It's going to $400. We have been very bullish on this name for a long time. And they're in front of AI more so than Amazon, more so than Google at this point, and we think that they're leading the charge. Remember, they lost the cloud war. They were number 2. They were number 1. Nadella, the CEO, is like, we're not going to be number 2. We are going to be out there. We're going to be on the field first, and we're going to show everyone where we're at. So they're doing a phenomenal job of controlling the narrative out in front. We had their executives at our software conference just a couple of weeks ago. I mean, the execs are falling out of their chair in terms of the ROI, the pricing, the excitement among the customers. Again, this is a phased launch of AI. It's not all going to hit this summer. It'll phase through the end of the year into early 24. But I think when you kind of talk about the quality of the Adobe management team and the quality of the financials and the products and the innovation, Microsoft's in the same class. With AI, they are at the lead of their class. And so right now, Amazon won the first wave of public cloud with AWS at an $85 billion run rate. We think that Microsoft's now going to lead the next generation of this cloud war. And everyone kind of counted them out here, and I think they're on their way back. It's almost what Ricky Fowler did in the U.S. Open today. Everyone thought Ricky Fowler wasn't going to shoot well, and the guy went out and shot him -8. I mean, incredible recovery. And look, owe it to Nadella. I mean, he's the best leader in tech. We think ultimately he's doing a phenomenal job. And again, I think the story is just getting going for Microsoft and AI. And again, the biggest concern right now, and we've said this, is that everyone is now long these names. It's an expectation game, and the stock has had a big move. So, but I think ultimately we believe there's still a really good runway to $400.
I mean, even Fowler still has Scotty Scheffler not too far behind him. Brent, I knew I could count on you to keep me updated on what I haven't been able to watch, or at least not
Sorry if I gave it away. Sorry if I gave it away.
It's okay. I couldn't watch a full screen on my desk today. I had to do some work. But Brent, appreciate the time and the update on the sports ball out there as well. Brent Thill, we got to check back in with you on Microsoft and all things tech. Thanks so much.
Take care.
Take care. Guys, coming up, those hidden fees on ticketing websites may be a thing of the past. We go around the horn and check in on some of today's top stories when Yahoo Finance returns. Welcome back, everyone. Let's take a look at some of the top trending stories of the day here. We've got Brooke DePalma and Alexandra Canal. All right, Allie, why don't you kick things off for us? Well, I thought they were going to leave you on screen, but here you are.
Hello. Yeah, so I'm watching a news story today. Well, really, it's an ongoing story. But earlier today, President Biden, he met with executives from a slew of private companies like SeatGeek, Airbnb, Ticketmaster, which is owned by Live Nation, to discuss hidden junk fees. And this is something that Biden has been increasingly going after. And the point of this meeting was that these companies were going to start cracking down on that and offering different options for consumers so that they can see all-in pricing. So that includes the service charges, all the extra fees that you get at the end of the day. He called this a quote-unquote win for the consumer. So that's the story here. Yeah. But will it really change the needle? I think that's a big question. And of course, this all comes after the aftermath of the Taylor Swift Ticketmaster fiasco that we saw last year.
Exactly, right? I mean, I guess it's all about transparency. And this is that junk fees thing that Biden talked about cracking down on. I'm a fan of this because, look, when you go online and you look at the price and it tells you it's $100, I know they're more than that. Like if you're going to a Taylor Swift
way
or
more
Beyonce,
than that.
I know. Oh my gosh. I mean, the prices are way more than that, right? But then by the end, it shows the way more than that, the double, the 200, the 300, and that's on the nosebleed seat side.
Right, so basically it's like for these platforms to add those features so that consumers can more easily search for the all-in pricing so that you know what you're paying for rather than waiting until you get to your cart.
Nothing ignites your inner Jimmy McMillan. Of course, the man who once famously said and ran under the rent is too damn high party. The fees are too damn high.
They are.
But I have to say, what I was surprised to see, happy to see, was that this had bipartisan support. I mean, all Americans can agree that they want to see and acknowledge and understand exactly what they're paying for. And so that was certainly, and by the way, on the price of an actual ticket, Allie and I were discussing this before, but I mean, people are spending around $1,300 on average for tickets, but also for their outfits. People are traveling for Taylor Swift's concerts. And this is something that we're seeing with the Beyonce tour as well.
Beyond
I mean, so it's beyond just the ticket price here. And so the hidden fees being seen.
I had written down a couple.
But like, we also need to bring the fees down though, right? Transparency is one thing, but at the end of the day, if I'm still paying the same amount, I'm not going to be too happy about that.
Well, the artist would probably say, well, it's for all of us. If you really love us, you'll pay this. We'll see. We'll see. We'll see what the prices look like with the all-in.
It doesn't pay dividends. It's not for all of us.
The band.
I agree. I'm on Team Brad.
You play drums, so.
Okay. Well, yeah, that's fine. True. Support the band. Support the band.
Exactly. All right. Next up, this is another thing we're looking at. Schwab's recent Modern Wealth Survey revealing a twist in how Americans feel wealthy. Now, there was a number in there, though. They said the number in terms of feeling wealthy was 2.2 million. So that's the number. But more Americans defined wealth different ways, whether they were talking about well-being, relationships. More picked well-being over money. I was surprised by this.
I was surprised by that too.
Right? I mean, 40% picked well-being, 32% picked money.
But what I also was surprised about was the difference of younger generations, how they perceive wealth and how they're going. Let's talk Facebook. Well, not really anymore with Gen Z, but let's talk Instagram. Let's talk Snapchat.
Not even past
let's talk
Gen Z.
Younger generations and how they're interpreting wealth. I mean, they're using these platforms, seeing what other people are doing, and they consider others wealthy because of what they see them doing, going on vacation, making big purchases, going out with friends. And so this cross-comparing of wealthy and the way that younger generations are perceiving it was something that stood out to me in the report as well.
Yeah, and on that point of generational differences, interesting that millennials and Gen Z, they think they're wealthy as opposed to some of those.
I don't know who those people are, but
they think they are.
Was lower.
Exactly, and you think about student loans, you think about the last financial crisis, which heavily affected millennials. Despite all of that, they see themselves as wealthy. Millennials, 57% said that they feel rich compared to 46% of Gen Z and just 41% of Gen X and 40% of baby boomers. So I guess like they say, like more money, more problems. Maybe if you're younger, you're more focused on lifestyle, more focused on that flexibility, and that makes you feel more rich.
Right. In terms of the numbers, the dollars, like the overall, the average was 2.2 million is the number now to feel wealthy, but it varies by state as well. When we're talking about these pricier
cost
places
of living,
like the coast, San Francisco, it's over 4 million, New York, over 3 million. I mean, in terms of the numbers compared to the well-being, of course, I value well-being. I'd like to take a crack at the numbers to see if I still have those questions.
Yeah, absolutely. A few things that stuck out too, just in the context of where we are economically as well, and how people might be changing some of their spending going forward from this point. Looking ahead, 7 in 10 Americans say that they're likely to change their lifestyles within the next 12 months to have a more positive impact on the world, but that could be based on a range of inputs as well to their own personal finances. So that's going to be something to see where they reprioritize or reallocate funds based on that plan as well.
Right.
And finally here, for those who it doesn't matter where they're spending or how much they spend, the Michael Jordan effect, alive and well as a fan dropped over $1 million in an auction to nab Jordan's signed flu game sneakers. All right, so and there you're taking a look at the sneakers. For those who don't know, this is the Jordan 12 here that he wore en route to one of his championships. These called the flu game Jordans. And the story behind it, of course, is he was probably poisoned, actually. He probably had some food poisoning.
No.
That's what they said in Last Dance. They said he probably had food poisoning, yeah.
But
the night before he was supposed to play the Jazz.
someone poisoned him?
No.
Somebody dropped off food at his hotel room in Utah.
Okay. So there's a little bit of a conspiracy
here around these sneakers as well.
I mean, look, I'm just saying what they said on Last Dance. So, and they interviewed Jordan, so I mean, I guess there's some truth to it. But the market is hot right now, and I just wrote a story a couple weeks back on a Sotheby's private sale that was going forward about the Jordan Dynasty collection and where they were expecting some of those bids to come in. We had actually had someone on earlier on this year to say that entire collection could go for more than $100 million.
Wow. I mean, speaking of wealth, good Lord, that means money is no object.
Nothing.
Nothing at all.
I mean, and this wasn't even the highest sale on record for a pair of his Jordans.
Yeah,
you know?
And I mean, look, it's just going to continue to be interesting to see how some of the uber wealthy are, and especially those who are even more into sports than those who were probably uber wealthy before, because that's one thing that was interesting about what Sotheby's had told me about their consortium of buyers right now.
Yeah.
It's younger, it's more international, and you've got a lot of sports fans out there that are purchasing what's important to them in their fandom too.
And when you think about the total sneaker resale market, it continues to amaze me. I mean, I'm not a part of it, but I know many people who are. And it's said to reach a revenue of $51.2 billion by 2032. I mean, that's massive. In 2022, it was only $10.6 billion. Yeah. And those Michael Jordan shoes that you mentioned, I mean, those were $2.2 million that they sold for. Those are the 1998 NBA Finals sneakers. Okay. So getting up to date on my Michael Jordan sneaker fun facts, but it's just massive. And to think about how many people are pouring money into this, maybe they find wealth in this, they find value in this, and so it's certainly a hobby. Would you say?
Yeah, and it's
got to be the shoes.
It's a cultural moment too, right? With Air, the release of that movie Air, Michael Jordan. I feel like people are talking about him more. I mean, and there's certainly, like we've been saying, there's a market for this, not just for sneaker resales, but sports memorabilia in general has just ballooned. There was a recent study that said the market was expected to touch $35 billion this year, and then in 2032, which is less than 10 years from now, it's going to reach more than $227 billion.
Yeah, and
that is crazy.
I'm not surprised by that. I mean, look, like you said, there's the market for that. There's a show that was going to be going on Netflix about just
Ken Golden's,
sports.
Yeah,
exactly.
Show.
That's it.
And I believe this was his sale.
I know.
Wow.
Yes, you're right. You're right. My son's already collecting cards and trying to figure out.
Oh boy, you're in trouble, Diane.
I know how much he can. But he's a businessman at heart. He wants to sell them. So we'll see. We'll allow that.
That's a big space. Trading cards, all this just adding to the dollar amount in that market.
All right. We're gonna have to put a pin in our conversation. I always love this. Ali Canal, Brooke De Palma, thank you so much. All right, it is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Kava shares soaring in their market debut. The stock closing at $43.30 per share, nearly double the $22 IPO price. After today's move, the company is now valued at $4.8 billion. While there was plenty of investor appetite, the company, though, still not profitable.
Another stock on the rise today, Delta, the airline closing higher for the 15th straight day after announcing it is bringing back its dividend. Delta suspended the dividend back in March 2020 due to the COVID pandemic. During this win streak, Delta shares are up more than 20%. And it's not just Delta having a good run. Both United Airlines and American are up several days in a row.
And some breaking news to close out after the close. Disney CFO Christine McCarthy stepping down. She is taking family medical leave and will serve as an advisor while Disney searches for a successor. She served as CFO since 2015 and has been with the company since 2000. Kevin Lansbury, who is currently the finance chief for the parks business, will fill in on an interim basis.
Well, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. For Diane King Hall, Brad Smith, and the entire team, peace!